Profitable Business. This is session 3, and today we're going to get a little bit, this time we're going to get a little bit technical, and we're going to talk about cost analysis and what all is involved in a cost analysis and how it applies to your business. And a fancy way of looking at cost analysis is by just simplifying it and saying it's job costing. So we're going to take a look at job costing today, as well as cost analysis. Okay. So again, presented by myself, Jeremy Lott, with Foundation Accounting and Consulting, and by the HBA, the Salt Lake HBA. Just a quick recap again on my story. Used to be a landscape company owner and loved it. Did great things with it, had a lot of fun with it, but I never understood my money. I was always frustrated. I was always juggling money to make payroll and never really understood what was going on quite with my money. And so I eventually ended up in bankruptcy, went into my accountant. My accountant told me that he'd seen my bankruptcy coming for a long time, and that was really, really frustrating to me and kind of let me down. So I ended up instead changing at that moment my career, my path in life, to be a trusted advisor for the construction industry. So I went back to school, got my MBA, focused on accounting the whole time, and that's where I'm at now, is helping other construction business owners to better understand their money and to improve their cash flow. Okay, quick review from 2 times ago, the balance sheet. The equation for the balance sheet is assets minus liabilities equals equity. We have 3 main components of the balance sheet. The first is the assets, which we compared to the external parts of the vehicle, and that is what you own. We then have liabilities, which we compared to the many different features on a vehicle, and we compared that to what we owe. And then the third thing was the equity, and the equity we compared to the engine of the vehicle, and that is the value of the company to the business owners. So that's a quick review on balance sheet. Profit and loss. The equation for profit and loss is income minus expenses equals profit. Income is revenue, it's the sales of the company. We compared that to accelerating, the gas pedal on a car. We have expenses, which is everything that you pay out, and we compared that with the brake on a car, the braking system. And then we have cost of goods sold, which is a special type of expense that we compared to the RPM meter in your car. And cost of goods sold are typically a percentage of the total sales. And we want to keep that cost of goods sold as low a percent of the cost of the sales as possible to operate more efficiently. We talked about the statement of cash flows and compared that to the gas gauge in a vehicle, because cash is the gas of your vehicle. And so we compared it to the gas gauge. Cash is affected by profit and loss accounts, but it's also affected by some of the balance sheet accounts, which is why the balance in your bank account does not equal the profit that shows on your profit and loss. Okay? Without cash, you go nowhere. Cash is the gas of your company. And last time we spoke a little bit about time management. We talked about 8 Ds. 4 Ds of dividing up your time and 4 Ds of getting things done. And So dividing up your time, we talked about doing and said that the target for that was 80% of your time. Deciding, 2% of your time. Delegating, 8% of your time. And designing, 10% of your time. Again, those last two items, the delegating and the designing, are two things that we really need to be able to get into if we want to get out of firefighter mode in our company. So we want to be able to develop a company that we can step away from so that we're not just self-employed, instead we're business owners. Right. Then we talked about getting things done and the 4 Ds for that. First thing you want to do though is you want to empty your brain, get all of the different things that you need to do out of your head and onto a paper. Your brain is not intended for storing information. Your brain is intended for being creative and for solving problems. And so we want to get everything out of your head onto paper so that it's not, the brain capacity is not being used up by storing information. Helps you to be more creative and helps you to be able to better solve problems. Then we're going to go down that list and we're going to mark every item on that list as something we can do, and then we're going to do it right now if it takes like 3 minutes or less, as something that we can delegate, pass off to somebody else, as something that we can defer, which means that we're going to write it down on the calendar, we're just going to schedule it for a later date, or something we can drop, things that we can just write down on a maybe someday to-do list and file it away so that we have it there. The brain doesn't have to store it anymore, but it's not in the way of the things that you need to get done that are more expedient. Okay? We spoke a little bit about profit management and money management. And in that we talked about changing our mindset on the equation. So as we just reviewed, the equation for a profit and loss statement is income minus expenses equals profit. But when we look at an equation that way, we're using up as much of the income as we can on expenses, and then there's very little left over. So instead we change that equation by switching expenses and profit. We instead have income minus profit, which prioritizes the profit and makes it so that we actually can take that profit out earlier, equals expenses. And we talked a little bit about the reasoning behind that and how we tend to, as human beings, use up all of the resource that's available. So if we change this equation to income minus profit equals expenses, instead we're going to take out that profit first because we've prioritized it, and then the resource that we're going to use all up in expenses is what's left over after we take profit out. Okay? Then we talked about needle in a haystack. Go back through your profit and loss and through your balance sheet and find things that you can cut out. Things that are recurring payments, things that are like gym memberships, meaning that they're recurring payments but you're not using them, so you can cancel them. Next, we talked about setting up 4 different bank accounts: the income, the operating expenses, the profit account, and the payroll account. And we do this so that we have like an envelope system, so that we can figure out how much money we're going to spend in each of those categories each month. And then, as the next step, the transfer says we're going to transfer money on the 5th and the 20th of every month so that we can take it out and we can put it into those other categories. Okay, we're going to do that twice a month. And then we're only going to spend on our expenses from the operation expense account. We're only going to spend money on payroll from the payroll account, and the profit account is just going to sit somewhere and be untouched so that we can then exercise discipline and make sure that we keep that money in there so that we can then once a quarter take some money out and celebrate and hopefully save up money for big goals over a long period of time. Okay? So on to cost analysis. Like I said, another way of looking at cost analysis is job costing. Cost analysis is a key part of job costing. So the question here, do you know what it costs you to do a job? Do you know what it really costs you? A lot of people think they do, but then are surprised when I come in and start looking at things with them and find out how much it really costs to do the different job and to produce the different goods and services that you do. So are you sure? The answer to this question can make or break a company. If you don't really know what your true costs are and you're not confident about that, 100% confident about that, then it can break your company, because that means that you're bidding wrong, that means that your prices are going to be all wrong, and you're going to end up spending more than you bring in. So we're going to talk about what goes on your truck when you go to a job, right? So we have a truck, and with that truck we're going to load it up with our equipment that goes on the truck. We're going to put the materials for the job on the truck. We're going to put the people, the labor for the job on that truck. And then we're going to throw some other things on there too that we might not think about quite as often. Some of those things include the liability insurance. You have to have the liability insurance to do those jobs. So that goes on the truck with us. Cell phones also goes with us to the job site. Bulk parts like nails, things that we don't really count on a job site, but we still use. There's a lot of those things like glue and nails and screws and just different little odds and ends things. You know, plate covers for outlets, things like that. And workers' comp. Workers' comp is another thing that commonly goes on the truck with us to the job site. Okay? So all of these things are actually going with us to the job site, which means that we need to include them in our costs. Okay? And that's why I can ask at the start if you're confident, 100% confident that you're capturing all of your costs, because most people tend to leave out the rest of these things. They'll get the direct labor, they'll get the direct materials, but then the liability insurance, cell phone, bulk parts like nails, workers' comp, and there are other things too that we can figure out when we look at a profit and loss. But there are other things that need to go on that as well. Okay? There's the truck. Okay, so terminology. When I say costs versus expenses, as an accountant, I mean two very different things. Costs are everything that we just talked about. Direct labor, direct materials, and overhead. Those kind of things. Those are all costs, short for cost of goods sold. Expenses, I typically call selling, general, and admin expenses, which is the common accounting term. And for that, what we're looking at is things like the internet for your office, your rent for your office, all these kind of things that don't go up and down if we have more sales. Also, they don't go on the truck with us to the job site. Those are expenses, selling, general, and admin expenses. Okay? So again, costs of goods sold, direct labor, direct materials, and overhead. All the stuff that goes on the truck with us to the job site, not website, job site. of times people call selling general and admin overhead because they think it's the overhead to run the company. Actually, the overhead refers to costs, something with costs, okay? So when I say overhead, I'm not talking about selling general and admin expenses. When I say overhead, I'm talking about all those other things that go on the truck with us to the job site, okay? The cell phones, the workers' comp, the liability insurance, all those kind of things. The nails and the screws and the glue. So, in a cost analysis, the very first thing that we're going to do is we're going to pull up our accounting system. I use QuickBooks with my clients. You pull it up and you're going to pull up a profit and loss. I like to do 12 months, and then I like to do a cost analysis again once every quarter. So at the end of March, I'm going to pull up from April of 2020 through the end of March 2021. Okay. Then you're going to go down through that list, down through that profit and loss, and you're going to identify all direct and indirect costs. Now, direct costs are direct materials and direct labor. That's what the direct costs are. You want to go down and identify those. The indirect costs are the overhead items. Okay, again, all those things that go on the truck with us to the job site. And you're going to mark all of the indirect items in yellow. Okay? Then we're going to determine the cost driver for each individual cost. And that's what our first steps are going to be. Okay? And we'll explain all that here with the spreadsheet. Where should it show up there? Okay, so this is an example profit and loss. And on this, we have some different accounts from our profit and loss. And what we've done is we've gone down through and we've marked all of the overhead items in yellow. Okay? Just like we talked about in the steps there. So you can see as we go down through this, computer supplies and equipment, that's office stuff. That's selling general and admin. Contributions, same thing, SG&A. Dues and subscriptions, SG&A. And then we have our insurance, our liability and workers' comp insurance. Those things are overhead. We're going to include those in the cost to do our work. We go down more interest expense, office supplies, and office payroll. All those items are selling general and admin costs. But then we have officers' labor, which is going to go on the truck with us. And we have the designer's wages. Now, the difference between the officer's wages and the designer's wages is that we can easily say the designer spent this many hours on this project. With an officer, they may be on the phone with one person at 1 minute and then on the phone with another job at another minute and changing all day long. And it gets hard to track their specific hours and how much time they spend. So we're going to call that an overhead cost. And then on the other side, for professional, we have professional fees like accounting and legal and computer consultants. All those things, selling general and admin. They do not go toward us building things. Postage and delivery, rent, telephone, we're going to put on the truck with us. Taxes are selling general and admin. Training and conferences, that's going to go on the truck with us. That's something that helps us to be able to build things better, more efficiently, so we're going to put that on the truck with us. Meals and entertainment, selling general and admin. And then utilities, selling general and admin. And the last category we have on there is tools and machinery under 200 bucks. And those items are all things that go on the truck with us. So that's going to be overhead. So you can see again, we've got all of the overhead accounts marked in yellow. And all the others, the selling, general, and admin, are just white. Okay? The green stands for direct costs. That's direct labor. So the designer's wages, it's going to go to one specific job, and we can track that easily, so that's going to be direct labor. Okay? That's a cost that we can budget for easily. All right. So we've gone through, we've divided all this up. What we're going to do is we're going to take all of these yellow costs, all of these overhead costs, and we're going to throw them in one big bucket. Okay, all these costs we're throwing into one big bucket. Then we're going to take that bucket and we're going to pour out a little bit of those costs on every job. Now we have to figure out how much to pour on each job and how to do it, right? Because we can't just divide it by the number of jobs. We could, but then you would be spending a whole lot more on overhead on small jobs than you would on big jobs. It'd be a larger percentage of the job, okay? So now we're going to determine the allocation rates by putting all overhead costs in one big bucket, and we're going to divide that overhead by different cost drivers. We're going to call them cost drivers, okay? And we'll explain. So we've got workers' comp and direct payroll taxes. So what are those costs related to out in the work field? That one's pretty easy, direct labor, right? The more hours they're working, the higher workers' comp, the higher the payroll taxes. So those things will go up with the amount of direct labor. So we're going to take and divide those categories by the total direct labor. So we're going to add those totals up and divide it by our total direct labor. Okay? Whereas car and truck expenses, they tend to increase. You drive more when you have more materials, right? You have to make more trips to the vendors to pick up more materials. And so we're going to allocate those based on direct materials. So we now have two different buckets. We have a bucket of all of our overhead that we're going to relate to our direct labor, and we have our bucket of all of our overhead that we're going to relate to direct materials. We're going to add up those totals in the bucket, and you can see here we have a bucket total for direct labor and a total for direct materials. And then we're going to add up the cost driver. We're going to add up the total direct labor. The total direct labor for that period of time. And put it underneath the bucket. Then we're going to add up the total materials that we used for that period of time. And we're going to put it underneath the bucket. And then we're going to divide the bucket by the cost driver. The total direct labor, or the total direct materials. And that gives us an allocation rate. An allocation rate appears as a percentage, but it can also be thought of as dollars and cents. So for every dollar, this allocation rate for direct labor is 79.95%, 0.65% rather. So about 80%. Okay, we can also say that for every dollar of direct labor that we spend, we also spend 80 cents of overhead. So $1 worth of labor is not just $1. That's not all it costs us. It costs us $1.80. So we're going to add the two together. Same with materials. Materials is at about 5.5%. We're going to round it up and say it's 6%. So for every dollar of materials that we purchase, we have an additional 6 cents that we need to tack on top of that. So $1 worth of materials, I go and buy nails for $10. I'm going to tack on 6 cents for each dollar of those materials. So the total will end up $10.60. 10 times 6 gets us to 60. Okay. And there it is close up, right? So we have the buckets. We've added up those total buckets. So we have 2 buckets, one that's direct labor, one that's related to direct materials. And then we've added up the total direct labor for that period of time and the total materials for that period of time, and that's what we have under cost driver up there. And then we divide the bucket by the cost driver, and that gives us our percent, or the amount per dollar of direct labor or per dollar of direct material that we need to add on as costs. So you can see, especially with direct labor where it's 80 cents, if we are going into a job and we're just bidding our labor and then say marking it up 50%, well, it's 80% markup just to cover our costs. That's before we even make profit. Okay? So you can see how quickly you can get underneath a horrible situation. So then we have some questions, and the question is, how much do I have to make to, first of all, break even, second, to make a certain amount of profit, third, to buy a piece of equipment, or fourth, to pay down debt. These are lump sum amounts that we need to gather throughout the year in order to be able to make ends meet, right? So for each of these questions, we need to be able to find an answer, and this cost analysis that we're working on helps us get to that end answer. Okay? So we're going to keep working along here. The next step, we're going to calculate the contribution margin percentage by subtracting variable costs from income for the period analyzed. Okay? Variable costs is a new term that we've thrown out there. Variable costs mean that the cost change varies based on the amount of income. So as we saw, we had a certain amount for direct labor, and we had a certain amount for direct materials, and then we had overhead. And all those items get added together, and that's our total costs. And that total costs are going to then go up if we're doing more work, or down if we're doing less work. And so that's why we call them variable costs. Okay? So we're going to talk about the contribution margin here. And we're going to use all this to help us determine what our fixed costs are. So here's our scenario again. And up top, you can probably barely see it, the little box in the red. That's our cost driver calculation, our allocation rate calculation that we just did. And we're going to put all that amount, all those 4 numbers, the 2 bucket costs and the 2 cost driver costs, we're going to take those 4 and add them up and put them in cost of goods sold. Let's see if we have a closer view. Okay, so the total we have is $584,000. And that, again, includes direct material, direct labor, overhead related to labor, and overhead related to materials. Those 4 items. We've added all of those up, and we came up with the 584,000. Now the contribution margin we'll talk about in a second here, but we're going to take the total income for that time period that we're analyzing, and we're going to subtract the total cost of goods sold, and that gives us the contribution margin. Now the contribution margin is easiest to look at as how many cents of every dollar is going toward covering our fixed costs and our profit. Okay, so we figure out percentages in order to figure that out. So right here we have the 820,000 is our income. Of that total 820,000, 584,000 of it is spent on costs, which is 71.25%. Then we have the contribution margin, which is 28.75%. Okay? So what this tells us is that for every dollar of income that comes in, 71 cents goes toward covering costs. And that leaves us with 28 cents. So we now have 28 cents that we can use to cover our fixed expenses, our selling, general, and admin mostly, and our profit. So then we can go back to our profit and loss, and we can add up all the white items that we went over earlier, and that gives us our total fixed costs. And then the contribution margin minus the fixed costs is the profit. Now, a quick word on fixed costs. Fixed costs are a set amount, the rent. We can figure out how much we're going to pay for the year on rent. We can figure out how much we're going to pay for the year on our internet. We can figure out how much we're going to pay for the year for our office staff. We can figure all of these items out, and they're not going to go up or down. They're going to stay the same. And that's why we call them fixed costs. Okay? So these fixed costs are like a great big hill. We have to get up over that hill of fixed costs before we can get into the valley of profits on the other side. Okay, so we have to climb this hill, and then once we get over that hill, everything else is profit. And how do we climb that hill? Well, we climb that hill at 28 cents for every dollar. I'll let that sink in for a second. 28 cents of every dollar goes toward covering those fixed costs. Once we've covered those fixed costs, we're then into the valley of profits, and now 28 cents of every dollar is going straight to profit. It's just kind of a way to look at it and be able to understand where our money's going and how it's used. Okay? So that's kind of how a contribution margin works. Next thing we want to do is some planning, some budgeting. And we want to take a look at some of the different things that we can vary in the whole equation. So you can see the fixed costs, we're going to pass those on to the top line there. We know what our fixed costs are. But then we're going to have a line there for other and a line there for profit. Remember how we talked earlier about paying down debt or buying a new piece of equipment or even hiring a new person? We can go through and we can figure out how much it costs for each of those items. And we can plug them into the other here. And then we can determine how much profit we want, and we can plug it in there. So if we want 50,000 in profit at the end of the year, we can plug that into the equation here. Okay? And then the bottom line totals it all up. So we're going to sum up those three numbers. The fixed costs, those are going to stay the same. If we just want to look at breaking even, we're going to keep the other two boxes open. But if we want to purchase equipment, hire new people, pay down debt, some of those different things, we need to add up those totals for a year, either the monthly payments for a year, or the salaries for a year, or the amount of debt that we want to pay off in a year. And we put that in the other column. And then profit, same thing with the profit. We can pick a set amount that we want as profit at the end of the year. And the reason that we're doing this is we're trying to figure out how much we need to make in sales. Okay? In order to break even, and then also to meet these different criteria. Okay. All right. So the next step we're taking here is we're going to determine the break even. We're going to do that by setting the contribution margin to the variables total. We'll go over all this and show you in the spreadsheet here in a second. But remember the last slide that we had where we had the fixed costs, the other costs, the profit costs, and then the total? We're going to set our contribution margin as that amount, that total amount. That's the total we need in contribution margin in order to be able to break even. Okay. Then we're going to calculate income by dividing the contribution margin by the contribution margin percentage. So we know from earlier slides that the contribution margin is a percent of the total sales. We had the total sales, which was 100%. And then we had the costs, which was a percent of that. And then the rest, the leftover, was another percent. And that percent is the number we're going to use. Okay? Then we're going to calculate the cost of goods sold by multiplying the income by the cost of goods sold percentage that we calculated earlier. Okay, here's what it looks like. If you look really close, I know that's a long ways away, but if you look really close, you can see the arrows pointing to the different areas. That cost of goods sold number is going to go over and multiply by, or the percentage is going to multiply by the income. The contribution margin percentage is going to multiply by the contribution margin in order to figure out income. And here's what it looks like. Okay? So the very first thing we plug in here is the contribution margin. It's that total from the earlier slide that we were talking about. We're going to add up the total of our fixed costs, our other costs, and our profit. We're going to add up those. And that number goes right there on contribution margin. Okay? Fixed costs, other costs, profit, all come from that variable. Right now we have them set to 0 because we're looking for a true break even. We don't care about spending down debt or hiring new people or buying new equipment or anything like that. We're just wanting to know how much we need to make in order to break even. Okay? Then we divide that total income, or we divide that total contribution margin by the contribution margin percent, and that gives us our total income. So in this scenario, we have to make $447,000 of sales in order to break even. Then we can calculate the cost of goods sold as a percentage of the total income. Okay? So let's go over a quick review. So the first thing we're going to do is we're going to go down through our profit and loss, and we're going to mark in yellow all of the items that go on the truck with us. we used a couple different terms for that. We used overhead and we used variable expenses. Okay, overhead costs or variable costs. Those are the two items that's two different names for the same thing. We're going to mark them all in yellow here. Okay, once we've marked them all in yellow, we're going to divide them into buckets. So some of that yellow bucket is going to go into our labor-related bucket, and some of that is going to go into our material-related bucket. So now we've taken all of these yellow costs and added them up and thrown them into the appropriate buckets. Now that we've done that, what we're going to do is we're going to calculate our allocation rate. So we're going to add up the total amounts for our direct materials and our direct labor, and then divide the buckets by those two amounts. And that gives us two percentages there. And we're going to take the two percentages and we're going to use them when we're doing our bidding. We're going to add up our total direct labor and our total direct materials for when we're doing a bid, and we're going to add to it those percentages. So if we estimate a job has $100,000 of labor, we're then going to add 79.69% on top of that as overhead costs related to labor. So in other words, 790,000, almost 800,000, we're going to add. And then do the same thing with direct materials. We'll do our takeoff, we'll add up the total materials for the job, and then we're going to add on some overhead at 5.55%. So if we have 100,000 in materials, that's going to be $5,000 of overhead that we add on top of that. So if you're keeping track here, we have 100,000, we have 80,000, we have 100,000, and we have 5,000. So that's 200,000 for the 200s, 80,000, and 5,000. So our total true costs for that job are $285,000. And then we're going to mark it up. Okay. So we're going to mark up the $280,000, $285,000, rather than marking up the $200,000, which is what most people are doing. Right? I hope it makes sense. If not, you can always contact me. All right, then we're going to figure out our contribution margin. And our contribution margin is the income for that period of time on the profit and loss minus the total cost of goods sold, which is both buckets and both cost drivers. We're going to add those up all together, and that gives us our cost of goods sold. And then we take the income minus the cost of goods sold is our contribution margin. And again, the contribution margin is how many cents of every dollar are going toward covering that fixed expenses first, remember the hill, and then afterward toward profit, the valley of profit. Okay? And then we can add up all the white items from our profit and loss, and that's our total fixed costs. And we subtract our fixed costs from the contribution margin, and that should give us our total profit for the year. So that should match the total profit shown on the profit and loss. Then we're going to look at variables. With those variables, the first thing we have is fixed costs. And that just comes straight over from what we just calculated on the contribution margin. And then we have other costs. And the other costs are going to be things that we're planning for in the future, in the next upcoming year. Are we going to hire somebody? If so, add up the total wages for the year. How much does that cost? Are we going to buy a new piece of equipment? Let's add up the total payments for the year and see how much that is. Are we going to pay down debt? If so, let's add up the total amount we're going to pay down and put it in there as other. Okay? Those are the kind of things we can put in as other. And then we have the profit. We can set a fixed amount as profit, say 50,000 or 20,000 or 10,000 or 200,000, whatever. We can budget toward that. Okay. And then the last column there is the break even. And with the break even, we went over the math on it briefly. But basically the total of our variables goes to the cost contribution margin column or row. And then we're going to take that contribution margin, we're going to divide it by the percentage we calculated over here. And that amount will give us the total sales that we need in order to break even. And then we can multiply that income by the cost of goods sold percentage, and it'll tell us how much we're going to spend roughly in costs. Now the nice thing about being able to do this is we can now take and look at a $447,000 sales requirement, and we can say, okay, an average job for us is about $25,000. If an average job for us is about $25,000, we can then divide that $450,000 by the 25, which gives us 10. Nope. 4 times 4, which is 16, and 2 more, so it's 18. So that means we have to do 18 total jobs over the year. About 1.5 a month. Okay? As stated before, I know this part can be confusing. There's a lot of math involved here. There isn't in the other episodes. So don't be discouraged if you don't quite get it with this one. You can always call me, text me, email me. Here's my contact information. Again, my phone number is 801-440-4540. You can call or text that. 801-440-4540. Or then my email address, jeremy@foundationacs.com. That's jeremy@foundationacs, which stands for Accounting and Consulting Services, so acs.com. And then my website is foundationacs.com. So thank you. I know it's been a lot of numbers, it's been a lot of math. I hope some of it clicked for you. Again, feel free to contact me if you have any questions on it. I'm happy to explain it in more detail, go over it with you, and I will talk to you later.